One of the things I mentioned previously was that when you have these financial statements, you want to analyze them. So how do you do that? Well, one of the best ways of doing it is through the use of ratio analysis. It's a means of comparing numbers over a period of time and seeing how they are either improving or they are declining. So as you move further in your studies, especially if it's of an accounting or financial nature, you're going to find that there are hundreds, maybe even thousands of ratios that are out there. So I'm only going to concentrate right now on maybe 4 or 5 of them for you that pertain to personal financial planning and that will help you to see if you're on the right track. So let's pull up a continuation of that PowerPoint. And this, again, this is also in the Chapter 2 PowerPoint, which is available on the page for you in the module. So for balance sheet ratios, you want to take a look at the solvency ratio. So the total net worth, which, remember, the total net worth is the total assets minus total liabilities. The solvency ratio shows you how well your net worth is compared to your overall total assets, so that you want your net worth to be greater and greater over time. So the solvency ratio measures how much of a cushion you have before insolvency. So if you move from a ratio of 40 to, say, 30, that's a lower solvency amount, and there's that much less time before you are going to be solvent, but before you're going to be insolvent, I should say. So therefore, this is not a good way to go. If your solvency ratio is going down, that means you're becoming less and less solvent. Another really interesting ratio, a very important ratio, is the liquidity ratio. So here you're going to take your total liquid assets divided by your total current liabilities or your current debt. So your liquid assets would include cash, savings accounts, money market accounts, certificates of deposit that come due within, say, a year's time. You could include those that are longer term. Just understand that there may be some kind of a penalty if you liquidate them. So now you're going to compare those liquid assets then to your current debt. So liquidity ratio shows how long you could continue to pay your current debts with your existing liquid assets. So if your liquidity ratio moves from 15 to 30, that means that you have a higher liquidity ratio. And that's a good sign that you've gone from 15 to 30. You want to be careful if it's the reverse, if your liquidity ratio is going down. I can tell you from all of my studies, whether you're talking about wealthy individuals or corporations, what have you, liquidity is one of the most important things for any entity to have. If you do not have liquidity, you very likely are going to be going out of business, or you're going to, on a personal note, you're going to be declaring bankruptcy. So it is important that you have enough cash available in whatever form so that you can continue to pay your bills. So the liquidity is key because it's going to cover you on a short-term basis. You don't want to be in a position where you own all these assets that are not easy to sell, and you still have bills to pay on top of it. That's a sure sign that you could be headed for a disaster. So a couple more ratios for you. So we have a savings ratio. So in this case, you want to look at your cash surplus from your balance sheet. So this relates the cash surplus of your balance sheet to your net income, which is on the income statement. So the savings ratio is where you take the cash surplus divided by the net income. So if your savings ratio moves from 15 to 20, that's a good sign that means that you're saving a higher percentage than of your income. Next, we have a debt service ratio. This provides a measure of the ability to pay debts promptly. So if the debt service ratio, and basically debt service means how much you have to pay on a regular basis to cover anything that you owe, whether it's a mortgage or rent or what have you. But it's specifically debt. That would also include student loans too, by the way. So you take your total monthly loan payments divided by your monthly gross income. So if your debt service ratio moves from 15 to 30, is it good or bad? Well, the answer to that is it's bad, because it shows that your debt service is increasing. So remember that the higher amount of debt service that you have, just as you have to be cautionary when you have a high amount of debt, period. Your debt service, if that increases, these are payments that must be made to help you keep your good credit rating, and also, again, to stay out of bankruptcy. So the savings ratio is an indication of how much you're actually saving on your income statement. And you want to see that that continues to be in a good ratio, a good number. Debt service, you want to make sure that that stays on the lower side, because again, that's a percentage of your payment to pay your debts compared to the income that you have. Okay, a few more items here. Budgets. The cash budget reports the forecasted or estimated cash receipts and the forecasted or estimated cash expenses for the year. So what you're doing is you're looking at what you've done previously, and now you're going to estimate what the cash needs and the cash income is that you're going to have in the next period, whether it's by month or by year. And what you do is you compare these cash receipts that are budgeted to the actual cash receipts and expenses, the cash receipts and expenses that you have. The difference between the cash receipts and the cash budgets and the cash expenses and the cash budgets and the expense budgets is known as a variance. The actual, if your actual number is greater than budgeted, then you have a positive variance. Otherwise, you have a negative variance. So you'd rather have a positive variance. You'd rather be in a position where you're assuming on the low side and your actual results are better than what you assumed. You don't want to get too far out of balance with that. You don't want to be too conservative, because it's not going to be really a reflection of your true condition. But nevertheless, it's better to have a positive variance than it is to have a negative variance. Okay, so what happens when you have a budget deficit? So if you are spending more than your income. So what that means is you're going to have to liquidate enough savings or investments or borrow enough to meet the total budget shortfall for that year or even for that month. So this, again, if you're going to continue with this budget deficit over a period of time, not good for you financially. It's actually very bad. So what you'll need to do is, if this is something that's happening continually, then you've got to now look at your previous income statement or your budgeted income statement and look at your low priority expenses. What are those things that you're spending on that are not really necessary for you? okay, or any number that you can reduce to help to get you back in line. Like I said, even for example, if it was entertainment, you know, where you're going out to a restaurant or buying your lunch, can you still maintain those? Maybe instead of having it 5 times a week, doing it once a week. So at least you have something to look forward to each week. And then bringing your lunch or making your lunch or dinner at home. So you don't really have a lot of options here, folks. You either lower your expenses, or what you have to do is increase your income in the event that you continually have a budget deficit. For most people, it's easier to cut down on your expenses than it is to increase your income. I think most people would probably, you know, wish that they could increase their income. But of course, if they do that, they've got to make sure that they're still keeping their expenses in track, you know, keeping them a good track of them. Because it doesn't help you if you increase your income, but your expenses are increased as well, and then you're back to where you started from. So that's enough talking now about a budget deficit. So a concept that I'm going to introduce to you now, and we're going to review it later on, especially when we're talking about investments, something known as the time value of money. $1 today is worth more than $1 received in the future. This concept relies on compounding, which when interest earned each year is left in an account, the interest then becomes part of the balance, otherwise known as the principal. So you wind up getting interest not only on the original amount, the principal amount, but you also continue to get interest on the interest. And this is how you're going to wind up getting more money by use of this time value of money concept. So again, $1 today is worth more than $1 in the future. If you have $1 today, you can invest that money or put it away into a savings account and earn interest for that period of time. The future value refers to an amount that it's going to be in the future. So the value that you have today will grow to a certain amount. That amount that it's going to grow to is your future value. So, for example, what will $1,000 amount to in 2 years if it earns 10%? So you multiply that $1,000 by 1.1. The 1 represents the principal, the $1,000. The 0.1 represents 10%. Now, in addition to that, notice that this is for 2 years. So you're also going to multiply the 1,000 and the 1.1 by another 1.1. So that's going to actually give you compounding. You're going to receive interest on your interest. So let's look at it this way. If you're multiplying that $1,000 by 10% per year, you're going to wind up with $1,210. Now, think about what just happened here. 10% of $1,000 is $100. You're doing this over 2 years. So $100 by 2 years would equal $200, not $210. However, remember that the interest for the first year has now become part of the principal, so that you're earning interest not only on the original $1,000, you're now earning it starting the second year on the $1,100, which was the principal plus the first year worth of interest. So you can look at future value tables in your book. Appendix A is a way of doing the calculation. You can see that it gives you a factor of 1.21 for 10% over 2 years. You multiply that 1.21 by the amount that you're calculating for, which is $1,000. And sure enough, it gives you $1,210. We'll talk more about time value of money as we move forward. Okay, so this is a little bit more information going into the time value of money. Now, a couple other concepts for you before we close out this chapter. If you haven't taken economics yet, one of the really critical concepts really is primarily in the capitalistic system, but it would apply to other systems. It just doesn't work quite the same way. The law of supply and demand is something that enters into prices for you. And especially when you're looking to the future for your own personal needs, not only for the entire economy, but also for your personal needs, you need to understand this concept. So with the law of supply and demand for a given commodity, the higher the price, the less the people want to buy something, okay, which makes sense. If the price is higher, then fewer people can afford it. If the price gets lower, then more people can afford it, okay? So like it says here in the second bullet point, the lower the price, the more they want it. So this demand for goods and services is affected by things like a person's income and a person's tastes for the item. Demand is seen in the situation from the consumer's standpoint. Okay, so again, if you, the demand, which is the desire to have something, it's going to be greater if the price is lower. Demand goes down when prices go up. Okay, now that's the demand side of the law of supply and demand. Well, what about supply? So the supply is viewed from the producer's standpoint. So the higher the price for a product, the more the producer wants to produce that product. Makes sense. If I'm a manufacturing company and I can sell something for a higher price, I want to make as many of those things that I am making them because I'm going to make more and more profit each and every time. Okay, so the supply is affected by the cost of producing that good and service. So producers, they try to sell at the highest prices to make more revenue. The buyers, they want to buy at the lowest price. Okay, so again, so you see the difference here. The demand is brought on by the people who are going to buy. The supply is brought on by the people who manufacture the goods. Those who manufacture the goods want the higher price. Those who want the as much of the product as possible, the consumers, they want a lower price. So the point at which the supply equals the demand, that's known as equilibrium. So we move on to the next slide here. So if you're looking here where the Q is, notice that that's where supply and demand meets. If the manufacturer has makes more of a supply, that's going to mean that there's more product in the market, and essentially the demand is then going to the price rather is going to go down as the price as the demand starts to increase. Let me say that again. So the more the quantity of a good that is manufactured, the lower the price that's going to occur. The demand, if the prices get too high, then people are not going to be willing to buy those goods and services. If the supply is low, that's going to raise prices, and again, that's going to affect demand. It's going to, when the higher prices come in, then there's going to be a lower demand, and we'll talk more about this as we go through classes. And you can also review, if you'd like, the materials that are either in the book or in the attached items that I have in your module. So a few more things here. The price of money is interest. Okay. Years ago, you were not allowed to charge interest if you were lending money. It was considered something called usury. But then they realized that money has its own value. If you need to get money sooner than later, that has a value for you. If you get money right now, you can invest that money. These are things that were not necessarily available many years ago when they thought about, the idea of charging interest on a loan from between individuals. So the price of money is interest. If you borrow money, you pay interest on the amount that you borrow. If you lend money to the bank in the form of a checking, savings, or certificate of deposit, you are paid an interest rate. Okay, so when you are a borrower, you are paying interest. When you are a lender, which is really what you are when you're putting money into a bank, you're basically putting money into a checking account, savings, or certificate of deposit, maybe a bank money market account. You are then paid a rate of interest. The rate that you're going to be paid is less than the rate that you're charged to borrow. The difference in financial circles is known as the spread. So a bank is going to make money when they charge higher for loans than they do what they pay out for deposits. Remember, the bank is an intermediary. They are between the lender. I'm sorry, they are the lender, but they are between the borrower, the one who's getting a loan, and the depositor who is putting money into the bank. In both cases, there's interest involved. When the bank is lending money, they're going to get interest from the borrower. When people deposit money at the bank, then the bank is going to pay interest to those depositors. So the bank is acting as an intermediary. Is it possible that a depositor can lend money to an individual? Yes, that can happen. But in a lot of cases, people don't have that ability to do that. So that's where banks come in. They are an intermediary between borrowers and depositors. Okay, so just read this part over here about the time value of money and financial instruments. This will tell you a little bit more about the time value of money and using the appendixes that you have in your book. Also, I will be providing the tables for you at a later module so that you have them. So this way you don't have to keep referring back to your book. Okay, so here's another concept for you to understand too. And again, we'll go more over this later. The future value of an annuity. An annuity is a fixed sum of money that occurs annually. Now, there are ways of breaking it down on a monthly basis. That's beyond the scope of what we're trying to do right now. But just think in terms of it's a fixed sum of money that comes to you or is paid out from you on an annual basis. So what will, at the end of year 3, if you invest $1,000 now and $1,000 at the beginning of the next 2 years, assuming 10%, how much will that be? So you're looking to see how much you're going to have at the end of 3 years. 10% a year is being earned, and you're putting money 3 times into this future value, this annuity. Okay, so it's basically you're multiplying the 1, which is the amount of the amount that you are working with, the principal, which is $1,000 in this case, plus 1 times the interest rate that we're using, which is 10%. And you're doing that for so many years. You're doing it for year 1, and then you're doing it for year 2. The first one that you see here, that refers to the beginning amount that you are investing. The other 2 parts that are added involve the future investments after year 1 and after year 2. So the bottom line here is an annuity of $1,000 per year over 3 years at 10%, 1,000 times the factor which is in your Appendix B of your book, 3.310, so that you wind up with $3,310. So if you're paying $1,000 a year for 3 years and the interest rate that you're working with is 10%, you will wind up with $3,310. At the same time, if you want somebody to send you $1,000 a year, okay, over the next 3 years, if the interest rates are 10%, that annuity is worth $3,310. That's essentially what the person has to have to make sure that they send you the money each and every year to get to $3,310. So if you want to build an account of $3,310 in 3 years, what amount do you have to save in order to earn, if your savings rate is 10%, using your future value factor, you'll see that it's $1,000 a year. So $1,000 a year at 10% for 3 years will give you $3,310. So I hope that's clear. If it's not, don't be too concerned, but I would say that we'll cover more of this in a future topic. 2 more items. There's something called the rule of 72. This is the number of years it takes to double your money. So if you take the number 72 and divide it by the annual compound interest rate, you will find out how long it's going to take to double. So using the $1,000 we were talking about before, and interest rates were 10% that we're working with, divide 10 into 72, and you'll see that your money will double in 7.2 years. So if I put $1,000 in and interest rate is 10%, that 1,000 will become 2,000 in 7.2 years. And you can check it by using the future value factor, not the future value of an annuity factor, the future value factor. You're only talking about one number here, one payment. So you use the future value factor. If it was a series of payments, you'll use the future value of an annuity factor, which is in the back of your book. Okay, last item for this section, present value. We've been talking about the value of something in the future. Well, suppose you knew what the value was in the future, but now you want to bring it back to the present time. And when you're doing a number of analyses, you want to use the present value. Okay, so it's easier to compare one decision versus another when you bring everything back to the present value. So what is present value? Well, it's the value today of an amount that is to be received in the future. It's the amount that would have to be invested today at a given rate over a specified period of time to accumulate to the future amount. So for example, the present value of $1,210 to be received in 2 years at 10% would calculate out to the formula that you see right there. So $1,200 in 2 years is worth $1,000 today, because again, we're taking the $1,210, but that's a future value. We're going to now bring that back to the present value. And in a number of instances, you're dividing instead of multiplying. Okay. And that will get you to the $1,000. That's what the present value is. So you can use the appendix, the present value factor in Appendix C to get that number. You'll see that 0.826 is 10% over 2 years. That's the present value factor for that. Okay, more about this later. I just wanted to introduce these concepts to you. So stay tuned, and more videos to follow. Thank you.